today we're going to be learning about one of the world's leading technical indicators called RSI, Relative Strength Index. Now, RSI is one of the most popular tools, technical tools, that are used by traders as well as investors. RSI helps us see when a market is what we define as overbought or oversold. Now, we'll talk about that definition so you understand it shortly. But the Relative Strength Index, or RSI, is a momentum indicator, and it was developed by Welles Wilder. What a great name, Welles Wilder. And was published in his book, New Concepts in Technical Trading Systems, in 1978. Well, the reason I mention this and why it's important is if you think in 1978, we didn't have online trading. We didn't have the internet. We didn't have Forex. We had a little bit of commodities trading at the CBO, Chicago Board of Exchange, mostly in agricultural livestock. We didn't have international news coming, international financial markets information. We didn't have economic calendars. And we didn't have traders like you and me. I take it back. I was trading already in 78. But I was trading on the Chicago Board of Exchange, and I traded my own account, but I traded only agriculturals. But what was available for trading to the general public and to brokers in those days was predominantly stocks. Now, stocks moved a lot slower. The markets moved a lot slower. We didn't have automatic charting. We didn't have data feeds. We would sit there waiting for numbers to come in through a ticker tape, and we would be hand charting. And we could slowly make decisions because there was no news letting us know that there was a strike in Brazil, so orange juice would go up. There was no news letting us know that a hurricane had blown into Florida, wiping out the orange juice crop. And we sure didn't know about Saudi Arabia energy and crude oil or problems with shipping crude. If you remember right, in the late 70s was the first time OPEC ever affected the global markets. So the world was a slower pace. So without going in too deep into the workings of RSI, is primarily used to attempt to identify overbought and oversold conditions when trading an instrument. Now, RSI is placed underneath our chart. And RSI is known as what's called a bounded oscillator, because RSI always, no matter what happens in its calculation, will come out between 0 and 100. It's just a mathematical setup of its formula. We use what's called the 50 line, the center line, as an indicator. We also set up boundaries. Basically, they start with 70 and 30. Anything above 70 is what we consider overbought. Anything below 30 is considered what is oversold. Now, again, I'm avoiding the involved definition of overbought and oversold, but we'll get there. Just too many traders think that overbought means to sell and oversold means to buy, but it doesn't. So again, RSI is an oscillator because it oscillates like a radioscope. Have you ever seen how it works on a radio? Bumping up and down, up and down, up and down between two numbers. We use these overbought and oversold extremes to see in which direction the price action will have momentum. Oscillators are typically used in conjunction with other technical analysis indicators to make trading decisions on entering trades. Now, the formula for RSI is very, very simple. RSI equals 100 minus 100 divided by 1 plus RS. Now, what is RS? RS is the average of up days or the average of down days when the market, the particular instrument closed up or down. Now, we can take the word days out there because we're looking at a 1 hour chart, we would be looking at the average of 14 days of when the instrument closed up or down and how much it closed up or down. So to simplify the calculation explanation, RSI has been broken down into basic components. RS, which is the average gain and the average loss. The RS calculation is based on 14 periods, whether it's 14 days you're looking at, whether you're looking at month calendar, 14 months, whether you're looking at a 1 hour chart and it's 14 1 hours. Now, 14 is what was suggested by Wilder and what has been tested in the market for many, many, many years. You can change the look back period, but then you change the outcome of the indicators. So the very first calculation for average gain and average loss is very simple. You go back 14 periods. You take the first average gain, and you take the sum of the gains, or the first average gain is equal to the sum of the gain over the last 14 periods divided by 14. So if it closed up 3 points, then the next time it closed up 2 points, next time it closed up 1 point, but you don't take negatives. If it closed down, it's not a gain. And then you divide that by 14. Then you take the first average losses, and those are the days that it closed lower. Okay. And you take those losses, each of those things, and divide that by 14. Then we take that to second, and so that gives us the first 14-day calculation for RSI. After that, we just take the previous day's average divided by 13 and add, or divided by 13 and add the 14th day, because we're always going back 14 periods. So taking the prior value plus the current value is a smoothing technique similar to that used in calculating exponential moving averages. This also means that the RSI values become more accurate as the calculation period extends. Wilder's formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. In fact, a plot of an RS looks very much like the plot of the RSI. So when there were no gains to measure, RSI is always 100. When there's no losses to measure, RSI is always going to be 0. So let's go over to a live chart and take a look at this, because you never have to do these calculations. I've got charts. Okay, there we go. Okay, so we're looking at my standard teaching chart. This is the Euro US dollar chart, and it's a 1 hour chart. 1 hour, Euro US dollar. And RSI is automatically plotted for us and calculated for us. So if we go to the settings, we can see that always we use the indicator time frame the same as the chart. So whatever our chart is, it'll change, but we could have it differently. We could use an 1 hour chart with a 45-minute RSI, but that gets very complicated. But there's all kinds of gurus out in the marketplace coming up with their own little adaptation to do this. And our look back period is standard to the 14, and we use the close of each of those 14 periods. You could choose to use a lot of other things. Today, our new HTML Java charts give us too many choices. And what we have is an upper band and a lower band and an RSI in our background. That is changing up the lower band so you can see it a little bit easier. These are just color corrections. Okay, so now see the orange dashed lines. That's at 70 and 30. The standard definition of the RSI indicator is based on a 30-70. A lot of people will adjust it to a 25-75, or some people a 20 and 80. It doesn't change the calculation, it just changes your boundaries. But right now, we can see that anytime price is over the 70 boundary, it's moved into what we call overbought territory. But overbought, like I said, doesn't mean to sell. Overbought can tell you the price has moved up too quickly and then lost a little bit of momentum. But an asset that's overbought can continue to be being overbought. So as we notice, the euro never lost its uptrend. So where it became overbought was this big push up here. We saw some sideways action, but it's recovered and kept its momentum. And we can see RSI drop back in below the 70. We don't have any oversold signals, in which you won't have during a nice formulated uptrend. Now, because you don't have to do any calculations anymore, we can see that RSI, based on 14, is right now at 49.25. We also see it automatically on our chart. The 50 line is critically important. Okay, the 50 line, when price moves up or above or below the 50 line, it tells us that the trend may be shifting and momentum may be shifting, but it's not critical yet, but it tells us there's something happening. Because we notice here, price has stayed well above or at that 50 line or over for quite some time. Now price dropped down, and even though this ease, that could be a simple retracement in an uptrend. But here's telling us we got a little thing to worry about here. Maybe it's losing its momentum. So here we're getting a forewarning, and RSI is telling us there's a loss of momentum here. But it hasn't moved into oversold territory. It hasn't moved closer to oversold. So we wouldn't, if we were in the market, we would not panic and leave. If we were looking to enter the market and we were looking for a lower price because we thought the price got to enter the market, this might be telling us this is an opportunity to buy. Because this could tell us it was just a simply retracement and it's going to continue its uptrend. So let's go back over to my PowerPoint. Oops, sorry about that. So RSI is considered overbought when above 70 and oversold below 30. These traditional levels can also be adjusted to better fit the security or the analytic requirements. Raising overbought to 80 or lowering it to 20 will reduce the number of overbought and oversold reasons. Short-term traders sometimes use 2-period RSIs to look back for overbought readings above 80 and over 20. Since RSI measures the relative strength of the underlying market, it is used as a technical tool that can be applied to nearly any market. However, it is commonly applied to the more liquid and larger markets like Forex, stocks, and commodities. Now, as I mentioned in the beginning, when Wilder developed this, there was virtually only the stock market that there were brokers, so to speak, trading. But over time, we've learned that RSI works extremely well in fast-paced liquid markets, and it's become one of the most predominantly used Forex indicators out there. It also works extremely well for cryptocurrency. In a downtrend, RSI can remain oversold. Use the center line to determine market direction. Settings can be adjusted for more or less oscillation. So there's lots of reasons we should use RSI. So when selecting the indicator to your chart, you will be prompted to change the parameters of the RSI. I would suggest that new traders keep it at the default of 14 period and the 70 and the 30. When the trend reversal happens, we want to get into the market and ride the trend as long as possible, and preferably until the next trend reversal. Now, once we become a little bit more experienced, we might think that something more sensitive or a shorter period will give us a better look at when a trend is happening or riding or reversing. And so one of the nice things is that you can adjust RSI to fit your style of trading, the instrument you're trading, the time frames you're trading. So RSI is used a number of ways. It gives us overbought and oversold conditions. It gives us RSI ranges, and it also gives us divergence. Now, I don't trade divergence. I don't even see it when it happens. Divergence is when the market is moving one direction and your indicator is moving in the opposite direction. Now, the rule of thumb is that divergence tells us there's a problem with the markets. Like I said, I don't trade from divergence. There's lots of people that swear by divergence. Not just RSI, there's lots of divergence for other assets. But you'll see that when you track, the best way to master and track RSI is to put it on the bottom of your chart and watch price action. Just sit back and watch price action and see where RSI is during your price action movements. Don't start trading it, just watch it. And you'll start to see it. And for different assets, you might want to adjust the sensitivity, but you'll start to get a feeling for RSI. It's not very complicated. And like I said, you don't have to calculate anything. You know, it was important for you to know the calculations just to have a better understanding. Now remember, during trends, the RSI will usually stay contained within certain readings. During a downtrend, the indicator will typically top out before 70 and frequently reach 20 or below. During an uptrend, it will be the reverse. Now, one problem with this strategy is that RSI may not provide an exit signal, in which case a winning trade could turn into a loser. Now, keep in mind, RSI gives you overbought and oversold conditions. It also tells you when momentum goes above 50 and below 50, but it doesn't take in consideration your trading. It's not telling you to enter the market at $1.22 and be able to exit the market at $1.34. RSI does not take into any consideration when the market might reverse in the opposite direction. So a lot of times you could have trades that the indicator was right, but there wasn't enough movement. There's big swings in the market, little swings in the market, and the indicator's changing quickly. It gave you a completely accurate signal, but you weren't able to execute the trade and get out and cover your spreads to make that trade. So remember, RSI is more of an alert. It smacks you on the back of the head and says, hey, trader, here's a potential for an opportunity. Go do your thing and figure it out. Because during a downtrend, short sell if the price rallies above 65 and then drops back down below. There's all kinds of strategies. Place a stop above the recent high. Cover the short position when the stock drops below 30 or 20 and rallies back above it. So one of the important things is understanding and feeling it, because it's not a magic number at exactly 70. Okay. But if RSI pushes and goes above it, we might want to look at what happens when it dips back in. Because as long as it's staying above, that means that there's still momentum with that stock to continue in the same direction. But you have to learn how to feel RSI. It's not a matter of a simple set of rules telling you do this, and do that. Now, RSI has several limitations, as all indicators do, since the indicator is showing momentum. As long as momentum remains strong, the indicator can stay in overbought and oversold territories for a long period of time. Therefore, price analysis or some other confirmation is still needed for reversals. The same is true with divergence. While the RSI may be dropping and the price rising, that doesn't mean prices will drop soon. The RSI is just showing that the price is moving higher at a slower pace than it was before. Remember, it's just showing you momentum. Imagine you've shot a rocket or a firework into the sky. Now it's traveling up, 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 up. Now we know at some point it's going to fall back to Earth. If you could mark with your eyes, a telescope, magnifying glasses, the point at which it starts losing momentum. It would be a very critical point, but just because it loses momentum, starts losing momentum, doesn't mean it's going to turn and fall to earth yet. We know eventually it will, but it could continue traveling up at a slower speed. It could actually be caught with a gust of wind and travel even higher. It could be a bright sunny day where the heat is helping let it rise farther through the hot air pockets. Okay, at some point it's going to turn back, but just because it started to lose momentum doesn't mean it's flipping back over. It just means that the price is still moving higher at a slower pace. Confirmation reversal is still needed, such as lower swing highs and lower swing lows. RSI ranges can help confirm trends, but each stock or market will have slightly different levels. One stock may repeatedly move to 38 on pullbacks, while another may only go to 33. Therefore, some adjustment is often needed for each stock or each market, since a one-size-fits-all approach may not work. And this is one of the important reasons for not trading tons of assets. If you know the market and you know the asset, you'll start to understand its sensitivity and how RSI reports, how all the indicators report, how price action works, so that you can feel what that indicator is trying to tell you for that particular asset. So the most basic RSI application is to use it to identify areas that are potentially overbought and oversold. Movements above 70 are interpreted as indicating overbought conditions. Conversely, movements under 30 reflect oversold conditions. And a level of 50 represents neutral market momentum and corresponds with the center line in other oscillators, such as also with MACD. In terms of market analysis and trading signals, RSI moves above the horizontal 30 reference is viewed as a bullish indicator, while RSI moving below the horizontal 70 reference level is seen as a bearish indicator. As with other momentum oscillators, overbought and oversold readings for RSI work best when prices are moving in a sideways range rather than trending up or trending down. So while it suggests the divergence between an asset's price movement and the RSI oscillator can signal a potential reversal. And like I mentioned, I don't trade divergence with any indicators. The reason is that these instances, directional momentum does not confirm price. As with the overbought and oversold levels, divergences are more likely to give false signals in the context of a strong trend. Now, RSI is a lot more reliable in a ranging market. And if you understand trading, you realize that most assets spend more time ranging or sideways movement than they do in a trend. But when the movements are moving sideways and then you get an indication above 70 or below 30, RSI can be a potential weapon to tell you that that market is about to start moving into a trend. Trend lines can be used on the RSI oscillator itself also to help analyze what it's trying to tell you. So remember, keep it in line, or keep watching the center line to see which direction momentum is taking the asset, and then watch for the boundaries above and below. All oscillators have center lines, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different, with a center line found in the middle of the range at a reading of 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy in the market. A drop below 50 would indicate the development of a new bearish trend. So the bottom line is that RSI is popular because it has multiple uses. It's also popular because it works. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help you spot or confirm reversals via divergence. Like any technical analysis tool, though, the RSI is prone to providing false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security or market. So RSI is a wonderful indicator. It works very well when used with price action, trending market support and resistance, and maybe an indicator like Bollinger Bands or MACD in combination to give you an outstanding trading strategy. So thank you very much for joining us. And in our future classes, we'll show you how to combine RSI and other indicators to build your own trading strategy. So if you have any questions, get in touch with us at Learn Extreme, and we'll be glad to help you out or show you the right classes to enroll for. Bye now.